Let's talk more about the banks as we gear up for an onslaught of earnings. Joining us now is Jeff Hart. He covers the financials for Piper Sandler. Jeff, great to see you again.
Good afternoon. Good to be back.
It didn't seem like there was anything wrong with the quarter. The management call seemed a little bit conservative, and I'm wondering what your take was.
Yeah, I think the reaction today was driven by a couple things. One is just the setup coming into the quarter. I mean, bank stocks have had a good month as the 10-year goes up, but it's always important to remember the 10-year tends to be good for bank stocks, not so good for bank fundamentals. So, I mean, they kind of probably ran up a little bit more than they should have given the interest rate environment. And I think there was some hope that we'd get incrementally more positive kind of outlook commentary out of JPMorgan. We didn't really get much on 2023, but it certainly wasn't kind of the incremental positive I think the market was looking for. So, I mean, there's some concerns out there about kind of the trajectory of expenses and, how good can that interest income be? But I mean, bottom line, the quarter beat my expectations and pretty much fundamentals did across the board as well. So I think it was a pretty good quarter, just a tough setup coming in.
Yeah, what do you take from the JPMorgan quarter and how do you use that to sort of, apply that to the other quarters that we're expecting tomorrow?
Well, a couple of things stood out. One is the strength of both advisory revenues and actually equity trading revenues. And those are big businesses for Morgan Stanley and Goldman Sachs to report the next couple of days. So, I mean, that should be good news for both of them. The overall investment banking stuff helps a Citi and a B of A as well, though I think the kind of lack of interest rate guidance and kind of the not really stepping up the loan growth expectations could prove a bit more of a headwind for both B of A and Citi the next couple of days as well. So I think that the outlook here is, at least for the quarter, I think a lot better for the capital market heavy names than kind of your traditional banks.
Yeah, what did you hear about credit card expenses that you think got extrapolated to the credit card companies today, the stocks, that caused them to be a little soft?
Yeah, we heard a couple things on credit cards, at least I was hearing back from investors concerned on. One was loan growth. And really, I don't think the substance of what we got was any different than we expected, though the tone seemed a little more conservative, which I think scared people a bit. But then also expenses, which for JPMorgan, some of the customer acquisition expenses actually run as a contra revenue. So it showed up in revenues, but they're spending to gain market share. And I think there's concern that the rest of the group's going to have to do the same to kind of keep pace. So you did see the credit card names kind of get hit today. But I think the reaction to the credit card stuff's overdone in that JPMorgan's spending, but it doesn't necessarily mean everybody else has to. And they're still getting pretty good returns there. And look, all the underlying drivers of loan growth, the stuff we can look for, like, consumer spending, deposit balances, and kind of the typical accounts that revolve have been getting kind of the excess work down. I mean, there's a lot of things that suggest, credit card loan growth is going to continue growing. It's just got a long way to get back to its pre-crisis levels.
How do you think about buy now, pay later and the popularity of that and the trend toward that and the impact on credit cards?
I think the impact is more one of kind of incremental profit margin erosion, right? I mean, it's not like the big banks or the credit card companies can't do buy now, pay later themselves. It's just a matter of getting the software there. I think that the hesitancy has been, it can eat into the credit card business, which is a pretty high margin business, but the demand's clearly there, and now you're starting to see, the JPMorgan certainly of the world rolling out the capabilities. So, I mean, I think the risk they face is kind of another incremental pressure on revenues potentially. There's a lot of growth there, but it's still a really small part of the market. So at some point in time, it gets to the point where that growth isn't quite as great. Some of the buy now, pay later companies maybe face some headwinds, but the banks are taking it seriously and getting in the game now, and I think you're going to see them kind of grow and take more share there.
All right, Jeff, great to see you. Thanks. Jeff Hart of Piper Sandler. Pete, I know we got your take on financials a little appetizer in the A block, but I'm wondering in terms of the banks that we're expecting tomorrow, which one are you focusing on?
Well, I would say this, Mel. When I look at JPMorgan, the fact that it is 2 times book, that was an issue for me because when I look at those numbers, they were great. And Jeff was just reiterating how strong those numbers really were, mostly at least across the board in equity trading. I think equity trading, investment banking, boy, I think that immediately starts to move me over to names like Morgan Stanley, Goldman Sachs, those kinds of names, more so than the actual bank names themselves, the Bank of America, Citi type names. So when I look at this, I think that there's some great opportunities. There are some very inexpensive banks out there that could potentially put up some numbers that we could actually see these stocks actually, I think, move to the upside in a big way. Names like Citi that trade less than 1 times book. So I think there's a lot of room there for some of these names to actually perform to the upside. Morgan Stanley would probably be my favorite coming up.
All right, well, let's pit your favorite against, a fintech company for Bonawyn. So Morgan Stanley or Square. Where do you want to be in financials?
Listen, going into earnings, I think Morgan Stanley set up well. I mean, you're looking at equity trading, and although that is much more volatile, I do think they're going to do extremely well there, and that has really carried the banks through COVID. Short term, definitely Morgan Stanley. Over the long term, I can see a company like Square continuing, or other DeFi. We talked about Sophie, a couple of days back. I can see these starting to siphon away market share, and I can understand the consternation around crypto and DeFi and these other alternatives. I think you need to have a little bit of both. Short term, definitely do what's more stable and what's a proven commodity. But I think you should be diversifying, and the consumer is showing you just that. Look at the consumer trends. They're involved in these fintech companies.
Grasso, your take?
Yeah, so real quick, PNC has the best chart in the financials. It's a regional. It's up 35% year to date, but it blows away all the other charts in the space. PNC comes out with earnings in 2 days, so it's on Friday. If I look at the charts, though, Bank of America seems pretty good, too. Always gets left out. It's up 42% year to date. Everyone talks about JPMorgan, Morgan Stanley, Goldman Sachs. Look at PNC, look at Bank of America, and look at Affirm. I'll give you a would you rather. I'd rather be in Affirm than Visa or MasterCard right now. Jeff just talked about it. It's going to eat away at the traditional credit card companies' profits. So, yes, they can pivot or they can buy an Affirm. You
know how Santa Claus keeps a list? Naughty and nice? That's what I do. FYI.
Yeah,
all right.
Yeah, Cole has rallied. I'll take it.